Is this market still being moved day to day by trade talk, or is something else underlying fundamentally here?
I think that good news sort of drip feed into the market narrative from trade has certainly helped. But actually, we've also been reinforced by some stabilization in global growth. And then we've also seen a better than expected earnings season. It had to step over quite a low bar. But all of those factors have helped lift equity markets over the last few months. And we continue to think that may happen into year end as well.
George, give me something bearish. All I've heard the past 5 days is Dow 30,000 by early 2020. What should we be concerned about here?
We should be concerned about a bull market that is older than Methuselah. Sooner or later, things change just because they do. And the U.S. consumer is running out of steam. The global economies aren't growing rapidly, and just after a while, enough is enough. And I'm afraid the bull market is not only long in the tooth, may have lost most of its teeth by now.
Well, if that's the case, I read in your note that you're actually saying folks might want to switch their portfolios from 60 equity, 40 bonds, flip it in the new year, right?
There's a phenomenon on Wall Street called bonus. And I don't want to accuse any of the nice people like me of avarice, but at the end of the year, the calendar turns and people get their bonuses. Once they've gotten their bonuses, they put them in the bank, they put them in their pocket, and they look around. What you've seen year after year, except last year, is that in the fourth quarter, stocks, and the stocks that have been the strongest, have gone up. Now, this isn't rigging the markets, but if you're a trader, you want to see the things where your bonuses are apt to be paid do well in the fourth quarter, and so you might buy more of it because you believe in it, and it also tends to...
Serves you well? Is that why?
it tends to insulate your bonus.
Okay.
Now get into the fourth quarter. Get beyond the fourth quarter, and you're in the first quarter. World is different. You take a fresh look at it. And if you're the capital providers, after a market that's up plus or minus 25% this year, you might say less capital, less of a positive bias, let's pull back. And I think that restacks the odds somewhat against the long side of the market starting in 2020. That doesn't guarantee it, doesn't mean it's going to happen, but it may stack the market the other way around.
Alex, you think we had a correction in early January?
I can see it coming, and my concern is with trade tensions. I think the market is making the mistake of seeing a US-China potential trade deal as the finishing line for global trade tensions. It's not. I think what will happen in early 2020, even if we resolve some of the pressures between the US and China, all that will happen is the area of focus switches from the US and China to US and European trade tensions. They are rumbling underneath the surface. Auto sanctions and tariffs have been delayed slightly, but there are some pressure points there. My concern is, however, that you'll see some economic escalation. If you go in with the same heavy-handed approach as the administration did with China to the Europeans, there's a good chance the Europeans will respond in kind. Up come the tariffs, up come the sanctions. That damages a fragile consumer in Europe and potentially sucks the US consumer into the fight as well. That's where I think we get concerned about market correction in early 2020.
And the retaliatory effects of problems with Europe could actually be much more damaging to the U.S. than with China.
Absolutely. If you look at how the Chinese have responded to U.S. sanctions, it's been a much more focused approach, going after one subset in particular, which is the agricultural community within the United States. It's not been a broad, scattered approach to responses. My concern with the Europeans is that they will respond in kind with a much wider array of sanctions and tariff placed on US goods, and that potentially does more economic damage to both the US and Europe. And also, I'd mention that Europe is not exactly in a particularly positive place from an economic point of view as well.
You can say that. Okay, Jared, you've got to look at the world. What's going on?
Lots of green here, although we did see Tokyo down about 0.5% and the Kospi down about 1/3%. But check out Hong Kong. It's up another 1.5% today. Over the last 2 days, almost 3%, which is pretty amazing given all the protests there. And on that note, Alibaba is preparing for its IPO over there in a couple days, and they had to shut down their book at noon instead of 4 p.m. because there was so much demand for this $13 billion offering. We see a lot of green. London's up 1% here. S&P 500 up 18 basis points. If we take a look at the 1 month price action here, looks like we got the opening bell in a few seconds. From the lower left to the upper right, 4.5% dips so mild you can barely see them.
All right, thanks, Jared. Here we have a new trading day at the New York Stock Exchange and the NASDAQ. We had some decent gains heading into the day. The Dow up 33 points. George, you say that the focus on tariffs is actually a bit of a distraction. So what should we be focusing on right now?
Well, there are two things. We could focus on earnings in the economies, but that doesn't seem to be popular in this day and age. One of the things that's the market driver, that gets talked about very little, is that algorithmic trading for profit is more than 50% of all trading these days. Now, algorithms are written by people, and people are unfortunately fallible. I wish we weren't, but we are. There is a positive bias built into most algorithmic formulas. Some part of that's for technical reasons. Part of it is just sort of the animal spirits. I feel good. Let's go to the long side of the market. And absent anything else, the algorithmic trading, which is unfortunately the dominant determinant of prices over the shorter term, is, fortunately, I guess, much more bull market oriented than bear market oriented. So on a day like today, where there's comparatively little news, the algorithms are more apt to set the tone, unless there's a trade development, such as Alex talks about, or some exogenous shock that would be difficult to predict. But watch the algorithms, because they are upwardly inclined, and all other things being equal over the shorter term, they will be the market trend determinant.
Well, the algos are certainly taking over today. The Dow, S&P 500, and NASDAQ have hit new record highs. So algos, to your point, George, are taking over. Alex, do you think the impeachment proceedings, they have largely been ignored? Do you think that will be a black swan event to the markets? I ask that because they have been completely ignored.
Yeah, I think at the moment what the market tries to digest whenever it's thinking about politics is what is the economic impact from anything that's happening in Washington or any other political event around the world. The challenge at the moment is that for something like the impeachments, there just isn't a lot of economic ramifications to the broader investment environment. So for the markets, for the time being, they're sort of shrugging their shoulders and waiting. Obviously, if things change and that we can actually distill some sort of economic and financial impact from these political events, then maybe the situation shifts, and it could shift quite quickly.
So it's trade more important than the impeachment?
I think for me, when it comes to talking to clients at the moment, it's trade, it's growth, and it's earnings. They're the three things that I keep investors focused upon and balanced when we're talking about the risks and the opportunities going into 2020.
Yeah.
If the impeachment hearings got to the point where the president was actually removed from office, though many say that is highly, highly unlikely, would that be a market-moving event?
That would be a market-moving event. To Alex's point on trades and tariffs, the unpredictable Trump tweet tantrums are short-term market movers. Now, the problem is nobody can predict those. I'm not sure the president himself can predict them, but that's something quite different. Impeachment would be a market shock that is not priced into today's levels at all. But Alex is right. If you look at the Irish punters, who I thought Irish only drank whiskey, I didn't know they were really very good at making book, but they appear to be. The probabilities of impeachment are very, very low and not in the markets at all yet.
But should a component of it be priced in?
No, really no. I mean, I think the odds against impeachment are 98-2 on the betting boards these days, and the 2% is tough to price into the market.
Sure.
Maybe it should be. Black swan wise, you're saying. Black swan wise, yes, there's probably an option bet out there, but that's not for the run-of-the-mill investor like me. That's somebody smarter than me has to look for that black swan.
You know, Alex, you mentioned earnings when you're talking to your clients. The market is pricing, I think, a reacceleration in earnings. Is it justified?
I think when we're getting now into the 11th year of this economic expansion, we have to be a little bit cautious about the earnings outlook going into 2020 and beyond. Earnings estimates for the next couple of quarters have started to come down slightly, but if you look out to late 2020 into 2021, analyst estimates are still close to double digits. That's going to be very difficult to achieve late in an economic cycle. The reason being is that the tightness in the labour market will eventually give rise to some wage pressure. That starts to put some pressure on profit margins. As you start to eat into profit margins, that's where earnings become difficult to deliver. Our models suggest low single-digit earnings growth for the next couple of years is much more achievable. That means earnings can help lift equity markets, but relying on them to deliver double-digit results is not the way to go.
You have got a deeper dive, Jared, into the Dow, which we should note is at a record high right now.
Yes, it is. And a lot of stocks in it are at or near record highs, like Apple, although it is off just marginally right now. And then Microsoft up 0.25%. And 10-year T-note yields are exactly flat today. They've been trending down since last Tuesday when the bond market reopened. But financials doing pretty well here. JP Morgan is up 0.4%, Goldman Sachs a third. And United Health, really kind of the poster child here for the comeback in healthcare that we saw beginning last Friday. Now, it has been doing well recently, but when Elizabeth Warren dialed back her Medicare for All plans, we saw healthcare just kind of explode to the upside. United Health is now the second biggest contributor to the Dow after Boeing because it is based on points. Also seeing Nike up 1%, McDonald's down 0.6%. If we look at the sectors, pretty cyclical and value-oriented here. We see financials, materials, tech, industrials, healthcare, communication services. All these are outperforming the S&P 500 right now, and that is a strong rally.
George, what stocks do you like here going into 2020?
If I sound bearish, I'm really not. Although our firm is in Houston, I've not been an energy bull. I would say that enterprise products, that Genesis, also an MLP, are very generous dividend payers. Dividends ought to be secure, and energy transport, I think, are down 7-8% this year when the market's up 25%. It's a good way to invest. Also, as a micro cap throwaway, I would say that the business development companies like Main Street Capital, like Capital Southwest, are high single, low double-digit dividend payers with their extras. They give high coupon equity and high coupon debt and get equity kickers from small companies. That's a very good business if you know how to lend well. If you don't, it's not at all good.